students. A very good morning to all of you. Today, after a short weekend break, we are starting afresh with a new spark, and I hope you have been good and healthy. Friends, today we have with us a very special guest, a man with an exceptional economic intelligence, a personality who is one of the prime pillars of the Indian banking sector, a mind who has sharp analytical skills that can penetrate the depths of finance. Friends, today we have with us the Keki Mistry, who is the man behind many successful stories. Best Independent Director Award, Best CEO Financial Services, Best CEO for Investor Relations India, Leader for Quality in Business. Keki sir has so far earned and been awarded by many titles like this. On behalf of HSNC University, on behalf of KC College and HR College, I heartily welcome you, sir. We are already feeling the immense wealth of joy by your magnetic presence. Keki sir is such a personality, friends, who by his caliber of playing a leading role in economic domain is regarded as one of the most influential business brains in India. I have had the good fortune of knowing sir since 2010 when I first called him in the morning and the year we were organizing International Conclave of Entrepreneurs. In 2 minutes, the reply came, instantly reply came, and he called back and saying that his support will be always there for this institution and HSNC board. He has always accepted our invitation to address our students at various occasions and has supported the endeavors of not only KC College, but the HSNC board. Thank you very much, sir, for joining this morning. Thank you once again for being with us today to share your significant principles of success and growth in life. So on this platform, I request you to continue your relationship with our institution. And now that we have embarked on the HSNC University, we would be looking at much closer academic association with you and HDFC. Thank you so much, sir. And once again, I extend a warmest welcome to you. Friends, I'm glad that sir is here to guide you all at the very onset of your career. My dear students, you are extremely fortunate to have Mr. Keki Mistry address you on this 13th day of induction program for the new academic year. Please make the best use of the session, especially those students who want to build their career in finance, management, and economics. Without further ado, I request Dr. Sen Gupta to formally introduce Mr. Keki Mistry sir to our young audience. And before concluding, once again, I extend a warm welcome and a big thank you to Mr. Mistry for accepting our invitation and coming to see us this morning and being part of our induction program. Thank you, sir.
Thank you, Principal Dr. Bagla, and good morning, everyone. I have the pleasant task of introducing our speaker for the day, Mr. Keki Mistry, Vice Chairman and CEO of HDFC. Recognized as India's best banker, best independent director, best CFO, best CEO for financial services, and many more, a trained boxer and an admirer of Hindi music, Mr. Keki Mistry began his career as a chartered accountant with A.F. Ferguson and Company. In 1981, he joined HDFC Limited, India's premier housing finance company. Since 2010, as the Vice Chairman and CEO of HDFC, he is responsible for its overall functioning. Mr. Mistry has played a critical role in the successful transformation of HDFC into India's leading financial services conglomerate by facilitating the formation of companies including HDFC Bank Limited, HDFC Asset Management Company Limited, HDFC Standard Life Insurance Company Limited, and HDFC Ergo General Insurance Company Limited. He has been on the board of several domestic and foreign companies. He is a consultant to the Asian Development Bank, housing development companies of Mauritius, Thailand, Caribbean islands, Jamaica, etc. As a successful leader, he believes that leadership is about giving people freedom and letting them be what they are. That's Mr. Keki Mistry for all of you, speaking on current economic perspectives and my learning principles in life. Welcome, sir, and over to you.
Thank you very, very much, Dr. Hemlata Bagla, Dr. Pooja Ramchandani, members of the faculty and students. Good morning to all of you. Thank you very much, first of all, for inviting me to speak to all your students. As this is induction week, I understand that all the students listening today have recently joined either KC or HR college and now have the proud distinction of being the first batch of the newly launched HSNC University. Both KC College and HR College are amongst the leading institutions in the city and have upheld their rich tradition over the years. It is good to see that you have matched your synergies to establish HSNC University. I do expect HSNC to be amongst the leading and the most prestigious universities in the whole of the country in the years to come. These institutions also have a common trait, which is they give equal importance to academic excellence as well as to extracurricular activities. Over the next few years, you will be armed with a good education and all-round skills, which will help in your future career as well as after you finish and you join India's workforce. As students of these colleges, you will start your professional lives with an inherent advantage. You will feel greater pride when you step out into the real world and appreciate the strong grounding that your college has imbibed in you. I will divide my talk into two parts. I will begin by giving you a sense of the way I see the economic situation, both globally and in India, followed by the principles which I've always used as a guiding tool, if you wish. And these are principles which have helped me throughout my life. Let me first start with the global economic perspective. In one of the most unprecedented events of our lifetime, something which at least I in my lifetime would never imagine would happen, COVID-19 pandemic has unleashed a macroeconomic earthquake in its wake. The sheer scale and speed of the unfolding human tragedy is overwhelming. Personally, I never imagined in my wildest dream that a virus outbreak of such gigantic proportions could happen in my lifetime and it would disrupt day-to-day life in such a big way and for such a long period of time. COVID-19 threatens to leave a permanent emotional and psychological scar long after the crisis is over. The rumblings of the pandemic began in December 2019, or that is at least the first time when we heard about it. But like other pandemics, in recent memory, it was thought that the spread would be limited and that a cure would be found soon. For instance, epidemics such as SARS and the H5N1 avian influenza that occurred in the early 2000s each had an impact of just 0.1% annual GDP loss to the global economy. It is estimated that the total fatalities from both these global epidemics was just over 1,000 lives. COVID-19 is very different as the transmission is a lot faster and it transmits through carriers who don't show any symptoms. The economic costs too are extremely difficult to comprehend. Almost all economists are unanimous in their view that the COVID-19 crisis is worse than the financial crisis of 2008. Global GDP is expected to contract by 4.9% in 2020, before rebounding by 5.4% in 2021 on a much lower base. Of course, the rebound hinges on the assumption that the health crisis will be contained along with the pace of the vaccine development and its distribution across the world. No statistical model was able to predict the sheer scale and speed of the crisis. IMF has stated that the COVID-19 pandemic has had a more negative impact on activity than was earlier anticipated, and there is still a huge degree of uncertainty in making estimates. Globally, central banks have been at the forefront in responding to the evolving crisis to ensure systematic financial stability. Various central banks across the globe have adopted massive quantitative easing programs, offered loan moratoriums. We've seen a similar thing here in India. so as to keep small businesses afloat. And many of these governments have been buying assets ranging from mortgage-backed securities, corporate bonds, municipality bonds, and even junk bonds to provide liquidity in the system. The main idea is that there should be enough liquidity available on a day-to-day life, both to consumers, to retail investors, and to these small businesses. Let's now look at what is happening in India. As regards India, India enforced, as you know, a very strict lockdown, which started from the 25th of March and continued up to the end of May. The economic cost of the lockdown, which began on March 25th, has been enormous and higher than anticipated, with significant losses in sectors such as agriculture, airlines, hospitality, real estate, and retail. India's GDP grew by 4.2% in FY 2020 against the earlier estimate of 5%. The fourth quarter GDP grew by 3.1%, reflecting the impact, the first impact, which was there in the early days of the COVID-19 lockdown on the Indian economy. Hence, I was not alarmed by the 23.9% contraction in the first quarter GDP numbers of India. For most sectors, 2/3 of the quarter entailed a strict lockdown. India was amongst a few major economies which imposed such a strict lockdown. Growth for FY 21 is likely to be a contraction. Currently the estimates range between -6.5% to -10% of GDP. It is important to reiterate that India is not an outlier in its GDP contraction. It is happening all over the world. The government is acutely aware that India cannot afford another lockdown, and hence the easing out measures are being done in a phased manner, in a very proper, well thought out manner. As regards corporate India, the overall performance during the first quarter of 2020 was as expected. It was weak. The weak performance was led by manufacturing companies, while service companies, especially those in the IT sector, remained in positive terrain. India Inc. is hoping that demand picks up as the lockdown measures continue to ease and keep easing in a bigger and bigger way. I can also say with a lot of conviction that the turnaround in the Indian economy that we have seen over the last couple of months has been significantly better than what had been anticipated in April and May, at least by people like me. Currently, we have been witnessing an all-round improvement in the Indian economy every month. And I would expect that by the time we come to the January quarter, the economy will be back to pre-COVID levels for most businesses. And hopefully, by the time we come to March, most businesses will start showing a growth in the quarter ended March 2021 compared to what they had in March 20. And that trend should continue in the quarters ahead. Some sectors such as e-commerce and agriculture have performed well during the lockdown, and there are some signs of revival in rural demand. Blue-collar jobs and the auto sectors are also showing a fair degree of improvement. Pent-up demand is expected to unfurl in the coming months. Let's look at what the regulators have done during this period. I think we have to compliment the RBI. I think RBI has done a fantastic job in ensuring that there is adequate liquidity in the system and that the liquidity reaches every segment of the market. And right from the time we had COVID-19, a lockdown in March till today, we have not seen one single company going down or one single company not having the resources to meet the commitments which they had. The Reserve Bank has been extremely proactive and has introduced a host of measures, including reducing the reverse repo rate twice since March 15, reducing both the repo rate and the reverse repo rate since March 15. The reduction in the repo rate has been as much as 115 basis points during the course of the last 6 odd months, and the current rate stands at around 4%. The previous instance, when the repo rate was reduced to sub 5%, was in April 2009, which was, of course, at the peak of the global financial crisis. As you recall, we had the global financial crisis, which started in the United States sometime in August, or maybe a little earlier, July 2008, and continued for almost a year. And that was really the peak of the financial crisis that the world has seen. After that, the next big crisis has been the COVID crisis. RBI has infused an estimated 9.57 lakh crores or 4.7% of the nominal GDP so that corporates have enough liquidity and better access to working capital. To augment liquidity in the system, the RBI reduced the reverse repo rate, cut the cash reserve ratio, conducted targeted long-term repo operations, and introduced refinancing schemes. Whilst RBI has done a very commendable job in continuing with its accommodative stance, bank credit has still not picked up the way one would like to see it. And this is especially to the weaker players, as there continues to be a fair degree of risk averseness in the system. I would say the degree of risk averseness has probably reduced over the last couple of months, but it would be wrong on my part to say that there is no risk averseness. There is risk averseness for sure. Bank credit is hovering around 6% levels on a year-on-year basis compared to over 10% in the previous year. People are risk averse due to the uncertainty of COVID-19, and many are protecting themselves from job losses and salary cuts. To ease the financial stress due to the intense disruption of COVID-19, the RBI, that is the Reserve Bank of India, has permitted banks and financial institutions to allow a moratorium on payment of installments for all term loans outstanding on March 1st, 2020. The extension of the moratorium was allowed up to August 31st, 2020. Now that the moratorium has ended, financial institutions are extremely concerned about the borrower's ability and, more importantly, their willingness to continue making their monthly payments on a month-to-month basis. These are still early days. One is hopeful that the Indian culture, which has always been, I would say, very pro making payments, ensuring that there are no defaults, I'm sure that culture will play out in the days and months to come. There is still some degree of fear amongst lenders, fund managers, and investors about the moratorium's impact on the credit culture and whether consumers will be able or willing to service loans post the moratorium. Time alone will show that. But as I said, I remain reasonably confident that the Indian culture is such that ultimately people will get back to being on track and the payments will come back to being on track. RBI has taken note of the fact that the economic fallout on account of COVID-19 has led to significant financial stress for a large number of borrowers across the board. The resultant stress could impact the viability of corporates with good track record, as their debt burdens have risen significantly compared to their cash flows. RBI has rightly said that such a widespread impact would pose a significant financial stability risk. Accordingly, RBI has approved a one-time restructuring plan for eligible corporate exposures as well as for personal loans. There is recognition on the part of the authorities that some sectors have suffered considerably more pain than others and would therefore merit a different treatment to facilitate a faster recovery. To explain further, a loans restructuring allows lenders to reset loan repayments or extend the loan tenor depending on the current repayment ability of the borrower. There has been an ongoing debate on how much fiscal stimulus the government should provide. Some experts have suggested that since India has a government debt to GDP ratio of around 68%, which is very modest compared to what you would see in most other countries, it can afford to spend a little more to get the economy back on track. Conversely, the government is worried about rating downgrades, which, if it happens, would increase the cost of borrowing all round, put pressure on the rupee, and affect investor sentiments. Fiscal deficit has already exceeded the budgeted target of 3.8% for FY20 to reach a 7-year high of 4.59%. Revenue collections have been relatively weak, and GST collections have fallen due to the pandemic. Tax collections too have declined consistently from 11.3% of GDP in FY18 to an estimated 9.6% in FY20. But these are things one should expect because this pandemic has come out of the blue. It is not just India which has been impacted, it is the entire world which has been impacted because of the pandemic. I do believe that India's pace of reforms, which has been a little bit on the back burner, needs to continue. Foreign investors need to be given the confidence that India is not headed for a structural slowdown. Sound regulatory policies and implementing structural reforms will help India attain a swift economic recovery. The manufacturing sector in India is in doldrums. Manufacturing grew by a measly 0.3% in FY20 and negative 39.3% in the first quarter of the current financial year. Positively, COVID-19 has provided a huge opportunity for India to establish itself as a manufacturing base for Western countries. Some of the positive signs are as follows. Firstly, India's foreign exchange reserves are at an extremely comfortable position of around US dollars 541 billion as of June 2020, which covers 14 months of imports. India is now the 5th largest holder of reserves after China, Japan, Switzerland, and Russia. India has been helped by low oil prices, which currently at around US dollars 40 per barrel. India imports 80% of its oil requirement, and hence import costs will become cheaper as a result of the fall in global oil prices. India's current account deficit is steadily falling over the years. During FY20, the current account deficit stood at just 0.9%. In fact, India achieved a current surplus of 0.1% in Q4 FY20. We may expect a continued balance of payment surplus in FY21, mostly driven by lower oil prices. The rupee is under control. In fact, the rupee has performed very well compared to what one could perhaps have expected in March and April. It has depreciated only by about 6% against the dollar since January 2020. India is much better off compared to other emerging economies such as Brazil, Russia, South Africa, and many other countries. In these countries, currencies have depreciated in mid to high teens against the dollar during this period. In fact, the Indian rupee has depreciated from rupees 75 levels in May to about rupees 73 half levels as we speak currently. The second, I would say the next point is that during financial year 2020, India FDI, foreign direct investment, of US dollars 49.98 billion. So you can say 50 billion US dollars, which registers a 13% growth over the previous year. Over the past few years, India is progressing on the World Bank's Ease of Doing Business Index. Last year, India recorded a jump of 14 positions to be ranked 63rd. And if you track this over the last 3 to 4 years, every year you see that India's position in the index of ease of doing business has been getting better and better year after year. The other positive is that India's monsoon is expected to end normal, and in many cases above normal. The Kharif crop cycle has not been affected by the crisis. Further, it is estimated that rural unemployment has come down significantly thanks to Narega and Kharif sowing. Apart from the opportunities in the manufacturing sector, which I had mentioned earlier, India has immense global opportunities in sectors like IT, back office, healthcare, fintech, and e-commerce. India is rapidly digitizing. India's digital economy is expected to be US dollars 1 trillion in 2025 when the total economy touches US dollars 5 trillion. That is one-fifth of the Indian economy will be in digital form. India has almost 700 million internet users and has tremendous potential to number manifold in the months and years to come. The high frequency data, be it e-toll collections, e-way bills, digital transactions, two-wheelers, passenger vehicles, tractors, electricity, fuel, freight, all these have shown sequential improving trends. When the pace of recovery is far from optimal, these indicators are harbingers that the worst is behind us. So clearly, it is very, very clear from my perspective that the worst was probably in the quarter, or not even the quarter, I would say the period April and May. And with every passing week, every passing month after June, things in India have been getting better and better. And even today, as we speak, there are some businesses which are recording a growth over what they had in the corresponding period at this time last year. So very clearly, the damage which was done during the first 4 or 5 months, to my mind, is behind us. And certainly I can say with a lot of confidence that the worst is behind us. Financial penetration in India is extremely low, which implies a huge potential for growth. Mortgage to GDP ratio in India is 10%. In China, it is 26%. And in the US, this ratio is 53%. Other indicators include insurance penetration in India stands at 3.7% of GDP. Malaysia, Thailand, and China have ratios close to 5% of GDP. India's mutual fund penetration is 13%, 1/3 of GDP, compared to 114% in the US and 73% in the UK. So all these factors, whether it is low penetration level in mortgages, financial services, insurance, general insurance, life insurance, health insurance, mutual funds, are all indicative of the fact that the growth opportunities for these businesses in the months and years to come is phenomenal. And that is the reason why we've seen so much of foreign investment finding its way into Indian markets over the last several years. I think also another very important factor is that we have favorable demographics in India. India accounts for 17% of the world population, or 1 out of every 6 person in the world is an Indian. 66% of this population is under the age of 35 years. India's middle class is estimated to rise from 250 million individuals currently to about 800 million by 2030. India is a domestic consumption-based economy. Private consumptions form 60%, 60, of the Indian economy. India is also poised to become the 3rd largest consumer market behind US and China. Consumer spending in India is expected to grow from US dollars 1.5 trillion at present to nearly US dollars 6 trillion by 2030. And lastly, there is no dearth of entrepreneurship in the country. India is the 3rd largest ecosystem for startups behind China and the US. So let me end this section by stressing that India will be fully recovered and achieve a sustainable growth rate. However, it is very important that we create jobs. This, in my view, is one of the greatest challenges. It is estimated that India needs to create 10 million jobs every year till 2030 to reduce unemployment. The availability of jobs today is much lower than what needs to be. India needs to focus on sectors that are job machines. These are in sectors such as construction, infrastructure, manufacturing, and labor, and knowledge-intensive service sectors. At a broader level, India just does not need an increase in the number of educational institutions, but more importantly, it needs an overhaul in the quality of education being imparted. We have been a nation churning out millions of graduates, MBAs, and engineers every year, yet less than half of them are directly employable without further training. This is where being from an institution like yours puts you at a distinct advantage. The skills I'm sure will attain the skills which will make you readily employable, and this will be inculcated in you in the years to come. So I told you in the beginning that I would talk of two sections. One was on the Indian economy, and the second section would be on some of the guiding principles which I've used in my life, in my career. So the first section on the economy is now behind us, it's over. So let me come to the second portion, which is my guiding principles. While I was composing my thoughts for this address, I wondered what it could be that I could share with you. After some deliberation, I thought I would like to use this opportunity to share with you some of these guiding principles that I picked up in my working career. Someday these may be of use to you. Each one of us goes through the cycle of success and failures, success and hardships. As we can see from COVID-19, a crisis can come from completely unforeseen circumstances. It is important to learn from extreme difficulties and emerge as a stronger player. My first principle that I would tell you is to be alert for the first signs of change. Change descends on everyone equally. It is just that some realize it faster, some realize it slower. Some changes are sudden, like COVID-19, but many others are gradual. While sudden changes get attention because they are dramatic, it is the gradual changes that are ignored till it is too late. You must have all heard of this story of the frog in boiling water. If the temperature of the water is suddenly increased, the frog realizes it and jumps out of the water. But if the temperature is increased very slowly, 1 degree at a time, the frog does not realize it till it boils to death. When you start your professional life, you will realize that it is critical for Sorry, let me just switch off the phone. When you start your professional life, you will realize that it is critical to be alert for changes in the external environment, which could lead to your skills or businesses becoming obsolete. Technological changes, for example, have proved to be disruptive for many businesses. You must develop your own early warning system, which warns you of changes and calls your attention to it. Second is anticipate change even when things are going right. Most people wait for something to go wrong before they think of change. It is like going to a doctor for a checkup only when you are seriously sick or thinking of maintaining your vehicle only when it breaks down. For many of us, the routine that we are accustomed to obstructs our ability to respond to a changed environment. There is a sense of predictability and therefore comfort in doing things the way we have always been used to doing. The biggest enemy of future success is past success. When you succeed, you feel that you must be doing everything right for it to happen. But when the parameters change, doing the same thing may or may not continue to lead to success. So my advice is always guard against complacency. Complacency makes you blind to the early signals from the environment that something is going wrong. The third principle I would like to say is do not allow your routine to become an addiction. For many of us, the routine that we are accustomed to obstructs our ability to respond to a changed environment. There is a sense of predictability and therefore comfort in doing something the way we have always been used to doing. While routines are useful, they do not let them enslave you. Deliberately break out of them from time to time. The fourth principle is realize that fear of the unknown is natural. With changes comes a feeling of insecurity. Many people believe that brave people are not afflicted by this malady. The truth is different. Everyone feels the fear of the unknown. Courage is not the absence of fear, but the ability to manage fear without getting paralyzed. Feel the fear, get that feeling of fear within you, but move on regardless. There is this old story I remember hearing of a pilot who, through no fault of his, the plane in which he was going, a small plane, crashed. And this was a military training plane. And immediately after that, the pilot was put into another flight and made to take off before he loses his confidence. So you must realize that fear has to be conquered and conquered very, very quickly. My fifth principle is keep reinventing yourself. This will prepare you to anticipate change and be ready for it when it comes. Constantly ask yourself what new skills and competencies will be needed in your area of specialization. Begin working on these new skills before it becomes inevitable for you to do so. That way, by doing that, you will have a natural advantage over other competitors. Never stop learning. You are never too old to learn something. Formal education is only the beginning, and it is only the first step in the journey of learning. In the world of tomorrow, only those individuals and organizations will succeed who have mastered the art of rapid and ongoing learning. My sixth principle is surround yourself with people who are open to change. If you are always in the company of cynics, you will soon find yourself becoming like them. A cynic knows all the reasons why something cannot be done. Instead, spend time with people who have a can-do approach. Choose your advisors and mentors carefully. Pessimism is contagious, but then so is enthusiasm. My advice to you is to always try to be enthusiastic and optimistic. Enthusiasm is not a virtue granted to some and not to others. All of us have it. Some of us choose to be in touch with it and display it, while others mask it and allow it to remain dormant. Enthusiasm is the quality that nourishes success. Demonstrate your enthusiasm for life and radiate it outwards in everything you do until it reflects on those around you. My seventh principle is play to win. I've said that many times in the past. Playing to win is not the same as cutting corners. When you play to win, you stretch yourself to your maximum and use all your potential. It also helps you to concentrate your energy on what you can influence instead of getting bogged down and worry about what you cannot change. Do your best and leave the rest to the Almighty. When you play to win, you stretch yourself to your maximum and use all your potential. It also helps you to concentrate your energy on what you can influence instead of getting bogged down and worry about what you cannot change. Do your best and leave the rest, as I said earlier, to the Almighty. 8, respect yourself. The world will reward you on your successes. Success requires no explanation and failure permits none. But you need to respect yourself enough so that your self-confidence remains intact, whether you succeed or fail. If you succeed 90% of the time, you are doing fine. If you are succeeding all the time, you should ask yourself whether you are taking enough risks. If you do not take enough risks, you may be losing out on many opportunities. My ninth principle is there will be times when things will not happen the way you would like them to. This will happen both in your personal and in your professional lives. Your self-confidence, which emerges from a positive attitude, will be crucial to ensure that you stay in control of unexpected situations. Do not get disheartened by temporary failures. Also, do not accept failures in life easily. Pursue your interests with wholehearted commitment, but do not be disheartened if you make mistakes. For that is the only way, I repeat, the only way that you will learn in life. Deliberately pursue activities in life in which previously you have shown little or no aptitude or where you have been a failure. The way out of fear of failure is to face it with perseverance rather than be embarrassed or intimidated. It is better to jump in and experience life than to stand on the sidelines fearing that something might go wrong. I have always enjoyed Thomas Edison's response to a reporter who asked him how he felt after having failed some 25 odd thousand times in his effort to invent a battery. His response was that I haven't failed. Today I know 25,000 different ways in which a battery should not be made. That is the spirit that you must have in life. My 10th principle that I would advise you is always strive for excellence. There is a vast difference between being good and being excellent. Excellence by itself is a moving target, and one has to be therefore one has to constantly keep raising the bar. My advice to you is to keep striving to excel in whatever it is that you are doing in your lives. My 11th principle is to be a good team player. It isn't always possible to run the whole mile alone. Remember that being able to get along and work with other people is a huge asset, a real huge asset, a real big asset in the world. People are important and nothing can happen without them. Stay humble, but believe in yourself. People say that success has 1,000 failures, but failure is an orphan. Some failures at some point of life, some point of time in life are inevitable. It is impossible to live without failing at something unless you live so cautiously that you might as well never have lived at all. Always remember that making mistakes is accepted by society so long as you own up to them and learn from them. My 12th principle in life is that you must remember that there are no shortcuts to long-term success. Do not get attracted by the false lure of greed. Success is attained by single-minded devotion and sustained hard work over long periods of time, during which your core values must be unshakable. 13, when you plan your career, you must have clear and well-defined goals. Just aiming for titles, recognition, and fame alone will not give you professional success or satisfaction. Lastly, and probably the most important learning in my life is never ever, I repeat, compromise on your principles or on your core values. My education taught me the importance of morality and having values. It taught me to distinguish between what was morally right and what was not. It taught me an important lesson, and that is that honesty, integrity, and transparency are time-tested traits that will never fail. Mahatma Gandhi said that you must open the windows of your mind, but you must not be swept off your feet by the breeze. Take your time to decide your core values, but once you have done that, do not compromise on them for any reason whatsoever. Integrity is one such value. Long-term success can come only through adhering to the highest possible level of integrity and ethical standards. The very fabric of a society or an organization and the trust in which it is held revolves around the level of integrity and ethics that it stands for and is known for. It is not difficult to achieve this reality. There is no pillow as soft as a clear conscience. Values like honesty, integrity, consideration, and humility have survived for generations. At the end of the day, it is values that define a person more than his achievements. Do not be tempted by shortcuts. Shortcuts can make you lose your way and end up becoming the longest way to reach your destination. An important piece of advice that I would like to leave you with is that irrespective of what success you achieve in your career, you must always remain humble. It is extremely important, in my view, to remain humble. More importantly, you must be humane. You must be humane, you must be accessible and approachable to people, no matter how small or unimportant they may be. Sometimes, when you achieve a lot of success in your life, you really start wondering whether you deserve all of it. This brings me to the value of gratitude. We have so much to be grateful for. Our parents, our teachers, and our seniors have done so much for us that we can never repay them. As you achieve success in your lives, in your careers, do not forget to give credit to those who made it happen. Your parents, teachers, friends, bosses, colleagues, they were all there to hoist you every step of the way. Your parents and teachers have given off their very soul in your upbringing and in your achievements, and your success is really their success. This is something you should never forget. The greatest fallacy would be to think that you did it all alone. One last piece of advice: enjoy your family, friends, and all well wishers before they are gone. Money, power, and fame cannot replace your family or friends or bring them back once they are no more. Finally, let me conclude by wishing each and every one of you every little bit of success in the path you have chosen for in your future. Remember, those who win are those who believe they can. It has truly been a privilege to to talk to all of you. I wish all of you nothing but the very best. Thank you very much.
Thank you very much, sir. This is Dr. Amit Nandu from HR College. Now we begin the round of question and answers. Before I pass it on to Nikita to read out the questions posed by students, uh, if you don't mind, sir, I have one question. How would the banking sector cope up with the high level of credit losses, which I anticipate might happen when the large-scale insolvencies might come in? You spoke about the role of RBI, that the RBI has managed that no, so far, not even a single company has gone down. But do you expect that to continue? Do you expect the insolvencies will not arise? And if they will, uh, how would HDFC cope up with it?
Let's not get specific into any company. We are not talking of HDFC. HDFC, for your information, is very highly capitalized. But let's talk in a more general sense. I think you have to understand that when you're in the business of lending, you have to take, there are risks that you take. Some risks pay off, some risks don't pay off. Uh, the the success of an organization depends on how well it is able to evaluate these risks. However, a pandemic like what we saw, COVID-19, has come out of the blue. Nobody in his right mind could have predicted something like this. But as I said in my talk earlier, things are getting much better. The economy is clearly getting better month after June. And therefore, my sense is, whilst in the short term there might be some degree of liquidity issues that some of the companies will face, I don't expect there to be major insolvencies or people not being able to to adhere to the commitments they had made in terms of making payment. The important thing to bear in mind is that for every financial institution at this point of time, you must remain capitalized. You must have adequate capital, and you must not over leverage yourself. So the capital measure in the form of capital adequacy is very critical. RBI prescribes a minimum threshold that banks and financial institutions are required to achieve. It is always advisable, in my view, to have about 3 or 4%, maybe not 3 or 4, but maybe 2 or 3, or maybe even 4% higher levels of capital adequacy than what has been prescribed by RBI. Higher level of capital adequacy means a lower return on equity, because your return on equity is a function of the level of capital you keep. And if you keep raising more capital and your denominator keeps rising, then to that extent your return on equity will get sacrificed. But for a financial institution, it is always better to remain safe, to remain solid, because that is what will bring long-term success. And I don't think there is going to be that much of losses that would come about. Yes, there could be temporary increase in non-performing loans for many of the banks and financial institutions in this coming quarter or two, but those, to my mind, will be short term. If you go back to any earlier crisis, you take the example of 2008, 2009, which was in the peak of the global financial crisis, across the board, non-performing loans in the banking system did tend to rise a little bit. It went up temporarily for 2 quarters, 3 quarters, maybe 4 quarters, but ultimately things came back to normal. So I have no doubt in my mind that ours is a resilient economy, ours is a growing economy, ours is a domestic economy, and as long as the basic fundamentals remain the same, our economy will come out of it very, very quickly.
Thanks a lot for your response, sir. Now I will hand over to Nikita to pose the questions posed by students. Thank you.
We have Saksham with us, who is a student
I'm
from
sorry, I can't hear you. I'm sorry, I can't hear you. I can't hear you.
Yes, yes. I am very sorry, sir. I have some network issue. We have a student with us, Saksham, who is an SMI student. We have the questions ready. He's going to read out the questions for you. Saksham, over to you.
Thank you so much, sir, for giving us the vast knowledge of the financial sector during the pandemic times. And thank you for enlightening us with your life principles that will surely help us and help all the viewers, those who are with us today. We have some questions, and with your permission, I'll take some of them forward. The first question is from Jagrati Sadhwani. The youth is really drawn towards foreign countries for career prospects as a result of better opportunities and as it's financially beneficial. What are your opinions on this?
Well, my personal opinion is that there are many people from abroad that I know of who Indians who've gone abroad in the earlier years who want to come back to India because they see opportunities in India. See, at the end of the day, India's GDP growth, but even if it is a little sustained at the moment, will in the medium to long term come back to around 7.5, 8% levels in the couple of years to come. Uh, no other country in the world, maybe with the exception of China, will be able to register those kind of GDP growths. And GDP growth means that much more opportunities will come up in terms of job creation, in terms of you know ability to do different things. So my advice to people is you may go abroad for studies if you wish, but ultimately India offers a much better opportunity in terms of jobs than what most of the foreign countries are offering. When I was young, did have a number of opportunities, for example, to go abroad and work, but I never did that. My daughter, for example, did her undergraduation in the US. She did her post graduation in the UK at LSC, but she's back in India and she's working in India and very happy working in India.
Thank you, sir. The next question is, the financial year for 2020 has been postponed a few times. What are its effects on private businesses?
Financial year has been postponed means what? Financial year has not been postponed. The financial year ended on March 31st, 2020. There was talk that the financial year would be extended, but that never happened. So the financial year did end on March 20. And as I was telling you, if you're talking of the economy, there was a temporary impact on the economy during the lockdown period. So from the middle of March till middle of I would say the end of May, things slowed down in a very, very big way. But with every passing day, with every passing week, and with every passing month thereafter, growth has been picking up. And if you see any of the business channels on TV, you will see that some of the industries, in fact, quite a few of the industries, are now registering in September, for example, a growth which is higher than what they had registered in September of last year, which is a huge departure from what had been earlier anticipated. So in March, when the pandemic happened and people were worried about COVID-19, there was general expectation that it would take more than a year for things to come back to normal. Things have normalized within 6 months.
Thank you, sir. We have the next question from Prajwal Chavan. What are some suggestible measures, according to you, that the government should take to remove the unemployment which is prevailing in India?
I would say that the main focus should be on sectors which create jobs. One of the sectors which creates a huge number of jobs is real estate, construction. Construction creates jobs both directly and indirectly. Directly in the form of construction workers, masons, carpenters, plumbers, engineers, and so many others. And indirect jobs in industries like cement, steel, paint, power, and so many ancillary industries that are associated with construction. So giving some fillip, giving some benefit to the construction sector, to the real estate sector, to the housing sector will result in a huge number of jobs getting created, both directly and more importantly, indirectly in some of these core sectors in the economy. So I would say the government should look at these sectors like construction and maybe a few manufacturing could be one such sector, identify what needs to be done to give a boost to that sector and try and do that.
Thank you, sir. We have a question from Darshan. The question is, sir, what are your views on actuaries in India, their role in economy and insurance industry, and is it a good career option?
Well, till the year 2000, we had only one life insurance company in the whole country, which was not 2000, not even 2000, till the year, yes, till 2000. We had only one life insurance company in the whole country, which was the Life Insurance Corporation. And we had the government-owned general insurance companies, be it New India Assurance, GIC, and a couple others, Oriental Bank, Oriental Commerce, and so on. Now, in 2000, the government permitted the entry of private sector companies in insurance. And with that came the birth of actuaries. So till 2000, the actuaries only worked with or largely worked with Life Insurance Corporation. And there were in the city like Mumbai, for example, really just one or two large actuarial firms which did actuarial valuation for companies for their retirement benefits of the employees and so on and so forth. So post 2000, actuaries are now in demand, in a lot of demand. Uh, I understand it's a difficult examination. It's a very long drawn examination. But yes, there are big opportunities in the sector because the insurance sector in India, be it life insurance, be it general insurance, continues to be extremely underpenetrated. And because it is such an underpenetrated sector, the growth for the insurance industry will be large. And if the insurance industry is to grow, actuaries will also be needed.
Thank you, sir. Can we take some more questions with your permission, sir?
Yeah, sure.
Thank you. So the next question is, when one starts to earn in their 20s, what are the best ways to invest?
I would say you should anticipate each person's investment philosophy should be different. You have to evolve your own investment philosophy depending upon your background, depending upon your financial condition, and depending obviously on your age, and depending upon a whole host of other factors. So it should be a combination of debt and equity. Equity cannot be kept, in my view, out of any investment plan, irrespective of whether you're 20 years old or you're 60 years old. There has to be some element of equity in your investment planning. The older you go, if you are not very well off, you should invest less in equities because equities gives you a hedge against inflation, but at the same time, equities carries with it a big risk. It carries with it the risk that your capital you can lose your capital because stock markets are volatile, stock markets can come down. We saw what COVID-19 did. Stock markets crashed without any fault of anyone's. So equities bring with it an element of risk. Debt has various components. You can have debt invested in mutual funds. You can have debt invested in buying government securities. You can have debt in the form of buying tax-free bonds, or you can have debt in the form of placing deposits with banks or financial institutions like HDFC, for example. So it depends on your age, it depends on your specific needs, it depends on your financial condition, it depends upon a whole host of other factors. So it's very difficult for me to give you one percentage. I would say that for a person who's reasonably well off and who's, let's say, 25 years of age, and you should put about this is my personal opinion, 60 to 70% of your money in equities and about 30 to a maximum of 40% in debt. That's my personal view. But as you grow older in life, if your financial position is weaker, you need more regular income. It depends on all of that.
Thank you, sir. We have a lot more questions on our comment section. I'll take one or two of them. Uh, the first question there is, what are your views on the impact of artificial intelligence on finance related jobs? Which skills are required to make a space for oneself in such a market?
See, I would say technology has changed so much in the last 20 years. When I was doing my college, when I was doing my even my articles with A.F. Ferguson in those days, we had one paper which was uh, called EDP and something it was called. So it was such an unimportant thing in those days, in the 70s, in the mid to late 70s. And today there can be no examination or no learning which can be completed without having a huge amount of focus on things like technology, artificial intelligence, and so on and so forth. So artificial intelligence is very much there to stay. It is you take the example of to give you, if you're fond, if you go to YouTube often and you're fond of watching a particular type of program. Let's say you're fond of watching let's say airlines or planes, how planes go. So inevitably, whenever you open YouTube under your name, you will get lots and lots of focus and lots of uh, displays of airlines and of air crashes and so on and so forth. So that is all comes from artificial intelligence. It's trying to understand what is there at the back of your mind and trying to give you the product or try to give you the service that you are looking for. So it's very important. It's there to stay. It will only get refined over a period of time and is very, very critical in today's world.
So much, sir. We have a question from Jigyasa Purohit. The question is, after shutting down of companies like Harley Davidson, what impact does this leave on the Indian market?
I'm sorry, shutting down which company?
Harley Davidson, the
I
motorbike
don't think it
company.
has I don't think it has too much of an impact on the Indian economy at all. I don't think it has, in fact, any impact on the Indian economy.
The next question is from Divesh Dugar. Many funds are raised for automotive sectors, but still the sector can't rise. What are your views?
Automotive sector. Automotive
Yes, sir.
means in what? What do you mean by automotive? Automobiles? You
The
mean
automobiles. Yes.
automobile sector? I think automobiles are there to stay. Why do we say that automobiles are not uh, are not successful? We have many very very good automobile companies in India. Whether it is Bajaj, whether it is Maruti, whether it is many of them, Eicher, so many of them are there, Honda, so many of them are there. So I think and what is also happening is that with COVID-19, more and more people are becoming uh, sort of aware of the need to have their own vehicles, so they don't have to the extent possible, move around in crowded trains or crowded buses because social distancing is very difficult to sort of adopt in these times. I'll give you the example of Mumbai. I come to work typically 3 days a week over the last month and a half or so. And every day that I come to work now, I find that the traffic on the road is not just pre-COVID levels, but it is more than what used to be pre-COVID. When in the olden days, it used to take me about 30 to 35 minutes to reach home in the evening. Today, it's taking me about 40 to 45 minutes to reach home. And that is it. The reason is that more and more people are out on the roads, more and more cars, more and more two-wheelers are out on the roads, simply because one is public transport is not easily available, and two, because people do not, to the extent possible, want to use public transport because there is a need for two-wheelers and four-wheelers because that's the way you can remain safe.
Thank you so much, sir. We'll take we'll take the last question for the day. That is from Ashish Tripathi. Do you believe that there is an urgent need for new kinds of jobs for the future? What are the examples of professions that will carve a niche for themselves in the future of Indian sectors, financial and otherwise?
See, when I was doing when I was in college, when I was your age, there were only 3 or 4 careers before you. You could either be a chartered accountant, you could be an engineer, you could be a doctor. So these were really the 3 professions that were available to me when in the 70s, in the early 70s. Today, you have such a vast sphere of jobs that are possible. Um, IT has changed all of that. To my mind, the number of new jobs that will get created will be in the new economy, which will be in IT and IT related services. I'm on the board of TCS, for example, and I know the number of new jobs, new people that they hire every year, and there are newer and newer job opportunities that are coming up for people. So the traditional jobs, I'm not saying that the traditional jobs are no longer important. You of course need to have doctors, you need to have chartered accountants, and you need to have engineers. But there are more and more variety of newer and newer jobs that are coming to the fore, largely led by the IT sector.
Thank you so much, sir. With this, I would like to hand over to Dr. Amit Nandu for proposing the formal vote of thanks. Over to you, sir.
Thank you very much, sir, for such an enlightening lecture. When I was given the responsibility of proposing the vote of thanks, I thought my job will be just very easy and I'll have to just say 1 or 2 lines. But it's become very difficult because I don't know what to summarize and what to say. It was such a wonderful lecture, sir. Such a wonderful lecture. I don't think I've ever heard a 45-minute lecture in which I've learned so much. And it was a perfect mix of a lecture in which we got to know about the current scenario, which answered a few of my questions. I was constantly wondering since the last 2 3 months that what is the Sensex doing at 39,000 when there are no positive indicators for the economy. Why, in fact, right now it's at 39,120, and I kept wondering, is it a true reflection? And the positivity that you infused today in all of us by giving us so much better statistics and so much. It was such an eye opener. I never knew that India has the fifth largest foreign exchange reserves. I mean, I never knew that we might have a current account, just such a low current account deficit, it might turn into positive. And I mean, so many things that you said, sir, today, which has infused so much of positivity in all of us. I really want to thank you from the bottom of my heart. The first thing that I'm going to do is make sure my son watches this lecture, and I think everyone should watch the recording of this lecture. It was such a enlightening one, and uh, more than that, the life principles that you shared, those 14 life principles that you shared in just 15 minutes, was something that has taught me so much. And my key takeaways from your lecture, I mean, a few quotes, a few statement of yours, which I will take together with me for the rest of my life. Something that you said was biggest enemy of the future success is past success. I mean, it's something that has really taught me a lot. Alert to be alert to the fear, to the first signs of change, which none of us do, and fear is normal, which reminded me of an incident from Mahabharata when Krishna asked Arjun, "Are you afraid of Karna?" And Arjun said, "Yes, because Karna is the reason why I am a better archer as compared to what I would have been if I had not feared him. So yes, I fear him." And that is something that you also said today, that fear of the unknown is natural, and play to win, a philosophy which I have always believed. When I used to tell my students about our intercollegiate activities, we would say that we don't go to participate, we go to win. And that is something that you also said just now. And excellence is a moving target. What a way to define it. And at the end, you said no pillow is as soft as a clear conscience. I think now I know why HDFC Bank is at where it is. If with leaders like you, I think the Indian economy is in great hands, and everyone should imbibe the qualities that you have you have displayed today, sir. I am really, really, really grateful for your lecture, and from the entire management of KC College, HR College, and BTTC College, I would propose a very, very hearty vote of thanks to you for coming here and sharing these pearls of wisdom, and which we wouldn't have otherwise got, sir. A very, very thank you from the bottom of my heart. Thanks, sir.
Thank you very much. I would have liked to have come personally and talk to all of you, but obviously in these times that is not going to be possible. Would be happy to talk again at some other point. Thank you.
Thank you, sir. Thank you. Thank you, sir.
Thank you. All the best. Good luck. Bye-bye.
Yeah, thank you so much, sir. Thank you so much, and we look forward to interacting with you very soon.
Sure. Thank you.
So, friends,
Bye-bye.
a last line I would add to my dear students, sir, on your behalf, that Keki sir was here today, and I'm sure that listening to his principles of life, which is a rare phenomena, we often see Keki sir talking on news channels and reading his wide suggestions and recommendations on the economy in magazines and new articles. But I wish you not only listen to all this, but also imbibe these principles in your life to do something remarkable like Keki sir. So thank you so much, Keki sir, once again on behalf of HSN University for joining us this morning. And tomorrow at 2 o'clock, again, we shall meet here to meet Mr. Dilip Vengsarkar. And you know that he's an Indian cricketer, former Indian cricketer and a cricket administrator who has been role model for our Virat Kohli and Sachin Tendulkar and Mahendra Dhoni. See, I'm not cricket fan, so the names don't come easily to me, but I know you are cricket fans out there. So be there tomorrow, 11 o'clock, and do share this information with your friends and your parents to be here and speaking to him. You can send your questions as we do always on YouTube. Get ready with that beforehand, and we will take the questions answers through tomorrow as well. So thank you so much, and I thank all entire team of HR and KC for such wonderful induction program. Thank you so much.
Ma'am, with your permission.